Welcome to the Financial Legacy Podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspective of my guest on financial and estate planning. And today we have a very special guest who is going to be talking to us about mortgages. So here we have Elise Levy she's a senior mortgage banker at Citizens Bank. Welcome to the show, Elise.
Thank you so much, Maria.
I know this is crazy times right now. So tell us, how long have you been, working with the bank, with Citizens Bank, providing mortgages?
Well, I've been in the business for over 27 years, and I've been with Citizens Bank for 5 years.
So tell us about the market right now. I know when we spoke briefly over the phone, you said, I don't know if I have time. It's so crazy right now. And everybody's applying for mortgages.
It's absolutely insane. And I have seen a lot of different cycles being in the business for nearly 3 decades.
Right.
And this, I remember a few times where it's been almost this busy, but I haven't seen it quite this busy and quite as frenetically busy. It's such an active market right now. Between the interest rates being low, and especially after the first of this year when we start to see vaccines roll out and more stimulus being pumped into the economy, I just think that it's really gotten anybody that was on the fence here in New York has just really realized that, wow, I need to get moving. I need to lock in a rate. And while sellers are still negotiable, I need to jump in. So it's been very active.
Yeah. What I'm finding out is that we're looking at a lot of investors, and oftentimes they are making offers and 2 or 3 or 4 different, properties. And of course, they aren't necessarily buying 3 or 4 or 5 different properties, but they're negotiating very hard in terms of, price reductions and concessions and whatnot. So in your case, you have to, be working with these buyers to be able to provide them mortgages that are going to help them in that process of acquiring property. What areas have you seen a lot of movement, a lot of requests?
The price point that I'm seeing is definitely on the lower end, probably in the 500,000 to $1 million, but also all the way up really in the $1 million to $1.3 million range is strong.
Mm-hmm, mm-hmm. And are you looking at primary home buyers or people wanting, or investors, or what's the nature of the investors at this point?
Mostly primary home buyers. I'm seeing a little investors, but a lot of primary home buyers or secondary home buyers.
Primary, secondary.
Vacation properties.
Yeah, vacation properties. So, what would be your advice for a buyer who is interested in getting qualified for a mortgage loan? What is the process of underwriting for you, and what makes your job easier, and what allows them to be able to be successful in obtaining a mortgage?
Good questions. Thank you for that, Maria. So probably the best that you could do for yourself is definitely think ahead and be proactive about getting pre-approved and making sure that all your finances are in order, because it's a very competitive market right now. So you definitely want to be sure that you have that pre-approval in hand so that when you're going out there looking at property, you're able to put in an offer and have the seller take you seriously with that pre-approval. Now, in New York City, we have co-ops and condos primarily. So I always tell people that there are 2 or 3 parts to an approval. If you're buying a single family residence, there's really 2 parts to the approval. But if you're buying a co-op or condo, there's 3 parts to the approval. And number 1 is the approval of them, which is the pre-approval, which you do before you go out looking. So once we've pre-approved somebody, I say, this is your ticket to shop. Now, the other 2 parts of the approval is if it's a co-op or condo building, I say you need to come back to me and let me know the address of the building so I can look it up and make sure that the building is approved, because the building is equally as important as you.
Correct.
And then the third part of the approval, which is something we can't really deal with ahead of time, but I think the buyer should be aware that lenders lend based upon the lesser of the purchase price or appraised value. So that if they were doing, say, 90% financing and the appraisal were to come in lower for any reason, that they're basing the financing off of that. So I always think these are really important areas to be aware of and to prepare yourself to know. So once the lender has looked at you, your income, and your assets to make sure it's sufficient, that you have the money for the down payment, that you have enough income to support the loan payments, and you have enough left over post closing, you're going to receive your pre-approval letter. Then you're going to go out and you're going to find your property. And once you have an accepted offer, at that point, you want to get right back in touch with your lender and start to gather up your paperwork so they can review it, so that by the time the contract is signed, you're just putting the loan into underwriting. Underwriting turn times right now are taking about 30 days, so expect 30 days to get approved from the time you have a fully executed contract.
What we are all familiar with the pre-approval letter, and we are all well familiar with the differences between a condo and a co-op. And you brought a good point in terms of not only the individual has to be approved, but also the building has to be approved.
Very
Tell us
much
a little bit about the differences between the condos and the co-ops, and what are some of the things that you look at when evaluating a particular loan request.
So when it comes to the co-ops and the condos, you have to realize that these are financial entities. So we are looking at their financials as well. So we want to make sure that the building is running at a positive cash flow, that a good amount of the units are owner occupied. Typically, a bank wants to see that at least half is owner occupied. We definitely make exceptions on that. And at Citizens Bank, we tend to be a bit more common sense than some of the other banks in terms of building approval. But you definitely want to make sure that everything is good with the building. Some things that banks look for is to make sure that no more than, say, 15% of the unit owners are delinquent on their maintenance. If there's litigation in the building, depending on the type of litigation, some litigation that's minor is fine, but if it's major litigation. So these are the kind of things that we look at. We send a questionnaire of all the things we want to know about the building to the management company, and we also collect the financials and the budget and the insurance on the building just to make sure it's in good order and that it's easily approvable.
Yeah, and so learning about the financials of the company is very revealing, especially the footnotes, because that's going to tell us, what's happening if they have a pending litigation, or if they have renovations that are coming up that are going to actually be increasing the monthly maintenance, and what percentage of the building is owned by the developer or versus what percentage is owned by the individuals. Yeah, those are all very important points.
Exactly.
Right?
And also they want to see that they're budgeting enough money and reserves just in case something comes up on the building.
Right. And so it's something that they have to manage very carefully, because the owners, whether it is a condo or a co-op, they don't want to have to pay more maintenance than they have to, or common charges in the case of a condominium.
Exactly.
So let's say it is somebody, first-time home buyer, what it is that they need to have in terms of documentations for you to consider a pre-approval.
If the potential client is fairly simple and they're a salaried borrower, we'll just really need to see their pay stubs and their W-2s. If they're self-employed, we are going to need to see business tax returns if they are an S Corp or a C Corp or they have a partnership. So we have to go a little bit deeper with collecting tax returns, business tax returns, as well as a year-to-date profit and loss and balance sheet on their current income.
Yeah, that's especially if it is an individual who owns a business. All of that is necessary. And also, I know that if you are dealing with people who they have a low salary, but that they have large bonuses, that's also a consideration, correct?
Exactly. So if a large portion of their income is variable, such as bonus income, we need to see a history of it. And we'd like to see that it's increasing. If it's increasing, we will take a 2-year average, but if it's declining, we need to know why it's declining, and we'll use the most recent year. So when it's any kind of income that's beyond salary, that's variable, such as even hourly is treated the same way as self-employed, or
Mm.
if somebody who's receiving commission income,
Right,
same thing.
right. Yeah, because that tends to vary, and then your approval process is based on cash flow. So,
Exactly.
so I mean, what are the three C's of any loan officer, right? You have to not only know it's cash flow is one of them, right?
Right.
And
Credit.
then get to know the client and get the credit is very important. For people, what would be your advice for, again, people who are starting in terms of how could they best take care of credit, the credit rating, so that when they apply for a loan, that does not become an issue?
Well, definitely that's part of the pre-approval process. We do run the credit history, and if we see that the credit is on the low side, their interest rate is directly impacted by the quality of their credit and their credit score. Everything is scored. So if you have a lower credit score, you're going to have a higher interest rate. So we'll see what is the reason why those credit scores are low. Is it because there were late payments in the past? Is it because there's not enough credit? Is it because they are charging um, a lot on their credit cards up to the point where the ideal place you want to be is charging no more than 10% of your limit. So if you're charged up to 80% of your limit, that could be weighing on your scores as well. So we sort of look at that. And if somebody's not buying in the immediate future, they have a few months to be working on it. I suggest that that they go for credit repair if they've had late payments, or to try and pay down their credit cards, if
Yeah,
that's the reason.
yeah, that's very important to try to reduce that balance
But what I
because.
tell people very importantly is that if they think that they don't have enough credit, to start opening credit
Mhm.
brings down your score. So I tell people that some of the things you need to do is to make sure not to open any new credit cards, and definitely not to close any credit cards. Closing hurts as much as opening. People will often look at their credit before they go apply for a mortgage, and they'll see, oh, I have all these accounts I'm no longer using, and they'll start closing them. And I say, oh no, because then it brings down the score.
Yeah, that's an interesting point because I thought that part of the process was, let's say somebody has five cards, five credit cards, and each credit card has a potential availability of, let's say, $5,000. So now you have out there $25,000 that they could probably use. That doesn't work against you. That is not part of the overall. The bankers don't assume that they could draw down on those lines and therefore jeopardize their credit rating?
That doesn't sound too excessive.
Okay.
That doesn't sound too excessive.
So it's all a matter
But
of moderation.
yes, it is very formulaic. So,
Okay.
and
All
it goes
right.
beyond my knowledge. But yes, what you described didn't sound too excessive. But I've seen people with pages and pages of available credit, and
Right.
then they say, oh, that could cause a whole
Right.
lot of damage there. Yeah.
Right. 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 What about those people who have been just negligent and maybe they haven't paid a medical bill because they don't, I mean, they have had insurance and they're pretty sure that the insurance have covered that. Nonetheless, is shown as unpaid in the credit report. Um, what's your recommendation?
It's unfortunate. I know a lot of people might even be in a dispute, and they feel like they absolutely should not have paid that. It should have been paid. That
Right.
this wasn't their fault, but now they're getting a mortgage, and the mortgage lender is going to say, we can't have out any outstanding debts when you close. You need to have
Right.
that paid up. And people often get angry, but they pay it, provide proof it's paid.
Yeah.
Yeah.
And I think if it is an old bill, as an example, it's very important to contact the you know company that is holding that unpaid balance and negotiate, because oftentimes they are very negotiable as well. So if you owe, let's say, $10,000, you might be able to reduce it to an amount that the debt collector, finds reasonable. So definitely, there's room for improvement there and negotiation. So now we have the pre-approval letter. What kinds of what is the process in terms of the underwriting process that you guys have? For instance, I know that debt to equity ratios are important. What other things do you look at when doing the underwriting?
Right. Well, as we discussed, the quality of the credit. So every bank will have their minimum credit score that they want to see. I will go down as low as a 660 credit score. The rates might not be as good as 60, but we definitely, credit is a factor. As you mentioned, housing expense and debts relative to income, which is known as debt to income or DTI. So the new housing expense and their current debts and any other mortgages that they're carrying all combined have to take up no more than, say, standardly 43% of their income, though we make exceptions to go higher than that. 43 is a really good guide. And then, of course, we want to make sure that they have enough money for the down payment, for closing costs, and for reserves left over. A bank is going to want to see that you have a certain amount of money left over. And that could be a couple months worth of mortgage payments and the total housing payments, including maintenance or homeowners insurance or homeowners association dues, common charges, maintenance, and as well. And sometimes we want it to be about 3 months. And then if it's a larger loan, it could be up to 6 months to a year's worth of housing payments left over.
To have enough money and enough cash flow to pay the monthly maintenance and the mortgage and everything that they
Yeah,
need.
to have, as far as cash goes, money goes, they want to have enough for the down payment, closing costs, and then reserves left over, which could be anywhere from, say, 3 months to a year's worth of mortgage payments, depending upon the size of the mortgage.
Right. And even I have many clients who just buy cash. Even when you have cash, it's important to have, and I have noticed, and I have had experience with some of our international buyers where the condo board is asking for a reserve for let's say 1 year payment of all the condo common charges.
Right.
So people want to make sure that they don't have, that whoever is taking over, whoever the owner is, has enough money to be able to meet its obligations.
Right.
So now you're on the underwriting process. The client has signed the contract. How long does it take after the contract has been signed to when you're actually given an approval letter or a commitment letter? And
Right.
what would the commitment letter look like? What are some of the conditions?
Well, the time that it's taking is about 30 days right now.
30, okay.
So there's going to be a mortgage contingency in the contract, and it's going to say when you need to get commitment by. And Citizens Bank has been really good about meeting those contingencies, whatever that date is, whether it be 30 or 45 days from contract signing. We're meeting all those dates. And whether there's conditions, we strive not to have conditions on the commitment as much as possible.
Right.
So we try to be extraordinarily thorough in gathering up all the documents and anticipating anything that an underwriter might need. But at the time of commitment, depending upon how long it took to get the commitment, we might need updated pay stubs, or if there's any large deposits on their bank statements that the underwriter is questioning, they might have to write a letter of explanation as to what those are. One of any number of things could come up that the underwriter might ask, but we really try to vet that out first and ask for everything in anticipation of what they would need.
Yeah, and oftentimes, especially the first-time buyers, oftentimes the parents will gift the down payment or a portion of the down payment to the buyers. So at that point in time, the underwriter is going to ask where that money come from. Was that a gift? Was that a loan? Because that's going to impact, right, the overall evaluation.
Exactly. And we'd really try to head that off before it goes into underwriting and have provided the paper trail that the underwriter is going to need so that they aren't conditioning for that. But yes, that is something that does come up often.
Again, for people who are first-time buyers, tell us a little bit, once we have the commitment letter, and we're actually going to be signing, closing, who is in the room and what's the interaction? We're going to know we're going to have the attorneys, we're going to have the bankers, we're going to have the insurance company, the title company, the agents. What is the role of the bank, and what is considered to be a successful closing?
Got it. Well, closings are quite different during COVID because people are not necessarily gathering around a table, but
Right.
traditionally it was buyer, seller, the real estate agent on the buy side and on the sell side, the attorney on the buy side and sale side, and the bank representative of the bank to come and close it, as well as the bank attorney. Nowadays we're seeing things happening in silos, that things are getting signed ahead of time and signed separately, and they're on Zoom calls, watching signatures happen and handling things that way. But the everything really takes, what makes a closing successful is really what's happening in the background, preparing for that closing day, that nothing's a surprise, that you've seen your closing disclosure, which you receive 3 days prior to your closing. The
Which is
buyer
the
will,
law.
what?
Which is the law.
Yes,
To
that's the law.
protect the
3 days prior
consumer.
to closing.
Yes.
So you know exactly what you're expecting in terms of cash to have at the closing table and the checks that you need to write. So you're going over that with your attorney. If there's any corrections or questions, you're questioning that 3 days prior. So that once you get there, you're just signing away. Just prepare an hour to just be signing and signing.
Absolutely. And I love those closings because they tend to be, everybody's prepared and everybody's, there are no surprises basically, and
Right.
closings tend to be very smooth. I have been in closings where it lasts a long time because sometimes disclosures have not been taken care of prior to going to closings, and that gets a little exciting, often between the buyers and the sellers and everybody else that is involved. We have 2 more minutes. so I'm going to, any final words that you like to tell people who are looking to apply for mortgages at Citizens Bank?
Yeah, just make sure that you be prepared. You go ahead, you get your pre-approval. You have a really good idea of the mortgage product that you want to go with, so we could go over those options, and you know exactly what to expect in terms of your monthly outlay. And for us to really just, sit down with your goals and to figure out what type of mortgage product that you want, but really back into where you're comfortable making monthly payments, so we can structure everything for a deal that makes sense for you.
Yeah, and we didn't touch base on the various mortgage products that we have, but again, that's very personalized because it could be an ARM, or it could be, which is variable, or it could be something that is fixed. So what are you looking at right now? What are people interested in? Are they doing short or longer term financing?
If they're financing up to the Fannie Mae limit, which is now increased just over 822,000, I'm seeing people going with fixed rates because Fannie Mae conforming fixed rates have become very, very competitive. And they had been, in the 2.75 range.
Right.
The adjustables for Fannie Mae size loans are really not, they're not as prevalent. So you're really seeing them on the fixed rate, but the fixed rates are so low. When it
Right.
comes to the jumbo loans, I'm seeing a lot of people going with 10-year adjustable products, which is a 30-year mortgage, but it's fixed for the first 10 years. It had been as low as 2.375 this week, and starting at the beginning of this year, we've seen rates edging up a little bit. But prior to the last couple of days, they had been at the 2.375 to 2.5% level for a 10-year adjustable.
Yeah, really. I mean, this is the time right now, as we started this conversation, how crazy it is that everybody's applying because, frankly, the rates are so low. We wonder how much longer it's going to continue. But with the new administration, it appears that they are interested in maintaining these low rates as people begin to gain confidence again in the overall economy and people finding jobs and whatnot. And certainly they do a lot of support as far as the housing market is concerned. So again, thank you again for joining us. I think this has been very educational. What's the best way for people to contact you if they want to be able to apply for a mortgage loan?
You would want to email me at Elise, Elise, dot Levy, Lev as in Victor E, at citizensbank.com.
Thanks again, Elise. Thank you, the audience, for being with us one more time here at the Financial Legacy Podcast, live.com. Feel free to contact us for a complimentary consultation. Thank you again, Elise. Be well.
Thank you. You too. Bye.
In providing answers, neither Maria Ellis nor the Financial Legacy Podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy Podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy Podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.